Okay, so let's start. We want to start our revision. And we want to start revising this topic called published accounts. Before I do the question I want us to do, let me just give you a brief overview. Of the topic. Now, when you are a public company, you are required as a public company to prepare what we call published accounts. Because we are revising, you should know when you as a public company you are preparing your set of published accounts, what should you include in that complete set of financial statement. When you are preparing your complete set of financial statements for publication purposes, what are the components that should be included in that complete set of financial statements? That's what I want to remind you. Which means we want to discuss the components of a complete set of financial statements. What are the components? Because you have also been asked before, what are the components of a complete set of financial statements? One of the things that you as a company you should include in your complete set of financial statement is, one, the income statement of your company. The income statement, some questions will call it statement of profit or loss. Some will call it statement of comprehensive income, but that is what we are saying should be included. Number two, the second thing as a public company you should include in a complete set of financial statements is what we call statement of financial position. You should include a statement of financial position. This is what you could also call a balance sheet, but we now sometimes call it statement of financial position. So that's the second component that should be included in a complete set of financial statements. Number three component is you are required to include what we call statement of changes in equity. You are required to include statement of changes in equity. Of course, you know how to prepare it. We shall remind ourselves. That's the third component that one, as a public company, you are required to include in your complete set of financial statements. Number four, you are required to include a statement of cash flows. That is what you could also call a cash flow statement or a statement of cash flows. It's the same. You're also required to include it as a component of your cash flows, as a component in a complete set of financial statements. Number five, you are required to include what we call explanatory notes. Or we can put it this way, you are required to include what we call accounting policy. You are required to include accounting policies and explanatory notes. So those are the five components in a complete set of financial statements. Good. For publication purposes. Now, because today we have new students, listen, let me mention this. Because today we have new students, for those new students who have joined us today for blocks and who have not subscribed, I would ask you to subscribe to my YouTube channel. Please subscribe to my YouTube channel so that you can be getting the videos that we shall be posting on the YouTube. So you can subscribe to my YouTube channel. You can even click down there, right to there where you are. You can see there is a subscription button. So if you have not subscribed, please subscribe by clicking that subscription button. Of course, my YouTube channel is called CPA Joseph Njuguna. My YouTube channel is called CPA Joseph Njuguna. You may want to refer to some of the videos I've posted there already. They are already there. Some of the videos relating to this subject. So that channel is called CPA Joseph Njuguna. So please subscribe to my YouTube channel. You can click on that subscription button below there and also hit that notification bell so that you are notified whenever we post new videos into the YouTube. Okay, so please, if you have not subscribed, please subscribe to my YouTube channel. So let me continue now. Let me continue as you are clicking that subscription button. Good. Now, we want to go through, listen carefully, we want to go through now, how do you prepare each of these components for publication purposes? For publication purposes, how do you prepare an income statement? How do you prepare that statement of financial position? Listen, the way to prepare them is slightly different from the way a company would prepare them for internal reporting. Remember, you are preparing these financial statements for publication for the members of the public. So their preparation have slightly different rules as to how you prepare them for publication or for internal reporting. So I want to remind you, because we are revising, I want to remind you what are some of the rules for preparing an income statement, for example, or what we are calling that statement. We said it's also called statement of profit or loss. Statement of profit or loss. How do you prepare it? Now let me start with it first. Let me start with it just to remind you. Good. So when you are required to prepare a statement of profit or loss, statement of profit or loss, this is what I've said. Some questions will call it income statement. Some questions will call it statement of comprehensive income, but it is the same concept. Now listen, you know that you have to start with your sales. Find out from the question, how much are the sales of that company, whatever they are. Then you normally come to what we call the cost of sales. Now listen, for cost of sales, it's true we know how we normally determine cost of sales. We normally take opening stock, add purchases, less closing stock. But listen, for purpose of publication purposes, you normally don't show the workings. You normally don't show the workings of the cost of sales on the face of the income statement. No, you don't show the workings for the cost of sales on the face of the income statement, like you used to do when you used to do financial accounting. You remember in the foundation level, or what they used to call section 1, when you did financial accounting, you had to show the workings for the cost of sales, opening stock, add purchases, less closing stock. But when it comes to published accounts, listen, you are required to do the calculation of the cost of sales somewhere as a working, and then bring it as a single amount in the statement of profit or loss. That's important, that you bring it as a single amount. Get the net, which gives you the gross profit now. Get the net, which gives you the gross profit. You also remember, listen, when you are doing this topic, or when you are doing income statement for a company, you normally minus expenses from the gross profit. That's true. But when it comes to income statement for publication purposes, I hope you still remember, because we are revising, you don't list the expenses individually. You normally don't list the expenses individually. Yani, you don't come and say less depreciation, salary, postage, insurance, maybe electricity, telephone, and so on. No. You know that all expenses should be classified. All expenses should be classified according to their function. Classify all your expenses according to the function those expenses are performing in your organization. There are two categories of functions that may be performed in an organization. One of them is the administration function. So find out from the question, what are these expenses that the company has incurred which are considered to be of administration in nature? All those expenses that are considered to be of administration in nature, again, listen, combine them somewhere and bring them figure for all of them as one amount. Combine all the administration expenses somewhere as a working and bring it as a single amount. So you come and say your admin expenses, you come and say admin expenses. Whatever it is, you minus. Then from there, the second function that may be performed in an organization is the function we call the selling and distribution function. The selling and distribution function. Again, find out from the question, which are these expenses that this company has incurred which are related to selling and distribution, which are related to selling and distribution. There are many, like advertising, depreciation of delivery van, salesman expenses, and so on. Many of them. But again, listen, you don't list them individually in the income statement. No, you are required to bring them here as a single amount under the name of selling and distribution, or you can just call it distribution expenses, whatever it is. Now listen, once you minus those two, you get what you normally get what we call profit from operations. You normally get what we call profit from operations. Then from there, you come and now charge what we used to call, we are revising, you charge what we call finance cost. Finance cost. One example of a finance cost is what we call the interest expense. Maybe interest on loan, interest on debentures, and so on. That is one example of a finance cost. Please tell me, what is another example of a finance cost when it comes to published accounts? There is another example of a cost that we normally classify as a finance cost. Give me another item that you can remember now that we are revising. Please chat and tell me what is another example of a finance cost. There are normally two examples. I've just given you one, and that is the interest charge for the year. But that may not be the only one in a particular question. What is another example? Give me another example. Give me another example of a finance cost. Give me another example of a finance cost. You chat and give me another example of a finance cost. I'm waiting. Now that we are revising, we are not learning for the first time. We are revising the topic. Give me another example of a finance cost. Other than interest, maybe on loan and debenture, what other example of a finance cost do you remember? Yes, I am waiting. What other example? Somebody to chat and give me another example of a finance cost. Wow. Yes. Somebody? An example of a finance cost. Okay. Okay, let me just remind you, we may not go into the details of it because the second one when we were discussing this topic in the normal class, we discussed it in details. I may not just go back into the details of it, but just to remind you, listen. Another example of a finance cost is what we called preference dividends. But not all types of preference dividends do you consider as a finance cost? Get the point there? Not all types of preference dividends do you consider to be a finance cost. Now that I've given you one example, tell me this. Which kind of preference dividends are these that we normally consider that they should be classified as a finance cost? Listen. In normal practice, dividends are normally an appropriation of profit. Dividends, whether on ordinary or on preference, they are normally an appropriation of profit. In other words, they are paid out of profits. But we are saying there is one type of dividend which we normally don't consider as an appropriation of profit, but we consider it as a finance cost. The question is this: which kind of dividend is this? Listen, is it preference dividend? Let me give you a hint so that you tell me. Is it preference dividends on what we call redeemable preference shares? Redeemable preference shares, or is it on what we call non-redeemable preference shares? I think now I've given you a hint where you can now tell me. The preference dividends, listen, the preference dividends that are considered as a finance cost are which kind of dividend? Listen, assuming we have two companies, one company issued a 10% redeemable preference share worth 20 million. Another company B issued a 10% non-redeemable preference shares, again worth 20 million. These two companies will still pay their shareholders a dividend of 2 million, 10% of 20. But which out of the 2 million will you consider the 2 million as a finance cost, not an appropriation of profit? Which of the two dividends? Is it dividend? My question is it dividend on redeemable or is it dividends on non-redeemable? That is very, very important, especially when it comes to exams. You have to check. If you find within your trial balance that you have preference shares, you must ask yourself, is this preference share redeemable or non-redeemable? So that if it's redeemable, you know where to treat the dividend for it. If it's non-redeemable, you also know where to treat the dividend for it. Yes. So, somebody, where do you treat the dividends on the dividend? Which dividend do you consider as a finance cost? Is it the dividend on redeemable or is it the dividend on non-redeemable? Okay, now listen, let me assist you. Now, before I even talk about that, listen, these two types of preference shares, the redeemable and the non-redeemable, listen carefully, the redeemable and the non-redeemable. Even when you are preparing the balance sheet, you don't take them to the balance sheet in the same place. Let's start from there first. That even when you are preparing the balance sheet for this company, you will not take the two types of shares in the same place in the balance sheet. No. Listen. Just like debentures, listen, just like debentures, we normally consider debentures as a long-term liability in the balance sheet. Debentures, we normally consider them as a long-term liability in the balance sheet. Why do we consider them as a long-term liability? Because you as a company, you must repay back your debenture holders. You must pay them back whatever you owe to them. Now listen. Now that debentures is a long-term liability, if you issued as a company, you issued a 10% debenture whose nominal value is 100 million, listen, it means that this year you are supposed to pay your debenture holders interest of how much? 10% of 100,000, that's an amount of 10 million. That's what you're supposed to pay them. So it means by you borrowing, you borrowed by issuing debentures. The cost of borrowing these debentures is the cost of financing. And that cost of financing is the interest you will pay to the providers of finance. So these debenture holders, you pay them a finance cost, which we call interest, because you borrowed. Okay? Now listen. Preference shares, I have said, can either be redeemable or non-redeemable. If they are redeemable, you know by definition, redeemable preference shares are those shares that when you as a company you issue them, you must pay them back. That's why we call redeemable. Listen. So redeemable preference shares, we normally don't consider them in the balance sheet as part of capital. The other point, redeemable preference shares, we normally don't consider them as part of capital. We consider them as part of a liability, as a long-term liability. Redeemable preference shares should always be considered in the balance sheet, not as part of capital, no, but we consider them as a long-term liability. Why? Because the moment you issued these preference shares, you must have told your shareholders, one time in the future, I will redeem them. In other words, I'll buy them back. I'll give you back your capital and give me back my certificate. So you as a company, if you issue redeemable preference shares, you have to consider them as a long-term liability. So together with the debentures, that's where you will take your 10% redeemable preference share, which is worth how much? 20 million. The other point, for the non-redeemable preference shares, you now take them to the balance sheet as a component of equity. So among the equities there, where you normally have ordinary share capital, it is there that you now take the 10% non-redeemable preference shares worth 20 million. Get the point now? So, in both of these two cases, you will still pay the preference shareholders their dividend of 2 million. But this dividend you are paying on redeemable, listen, this preference dividend you are paying on redeemable, you are paying on borrowed funds. You borrowed. You will have to pay back the 20 million because they are redeemable. So when it will come to a time of payment, because you will have to pay, then that is what I told you. Now you consider it as a long-term liability. But every year, you will be paying back the interest or the cost of borrowing these finances. How much? 10% of 20 million is 2 million. So the cost of borrowing through preference shares, the cost of borrowing through preference share is that 2 million. So that 2 million is the finance cost. You financed your business by borrowing. So get the point there, that the preference dividend I was referring to, which should be considered as a finance cost, is the preference dividend on, listen, on the redeemable preference shares, on the redeemable preference shares. Otherwise, the dividend on the non-redeemable, that's what you consider, the dividend on the non-redeemable, that's what you consider to be an appropriation of profit. So once you get the profit after tax and you want to appropriate that profit, now you appropriate. One of the appropriations is ordinary dividend. 2, preference dividend on non-redeemable preference shares. So I hope you have understood that point. Some of your past papers, listen, some of your past papers come with trial balances where the preference share is redeemable. Some questions come where preference share is non-redeemable. I've told you, if it's redeemable, then the dividend on the redeemable preference share should be considered as a finance cost. Why? Because you have to incur a cost of borrowing. This redeemable is borrowed. You will pay back. So the cost of borrowing, which we consider as finance cost, that should be classified as a finance cost. I also said, if it's non-redeemable, then you consider that dividend as an appropriation of profit. The other important point you need to take and note is that even in the balance sheet, we don't take them to the balance sheet the same place. I've told you, if it's a redeemable preference share, I have said it should be considered as a long-term liability. It should be considered as a long-term liability in the balance sheet if it's redeemable. Why? Because you must pay back. I have told you, if it's a non-redeemable preference share, then it should be considered as a component of equity. It should be considered as a component of equity down there. I hope you have understood. I hope you have understood that point. Now we can continue. So let me continue with the preparation of the income statement. We were at that point where we are saying you get the finance cost. Good. I'm assuming now you're through with the finance cost. Listen now. You now come to the next item, which we normally call investment income. Maybe as a company, you have received some investment. You have some investment, and those investments are giving you some income. Whatever is the investment income, it could be in form of dividend that you received from your shares, or maybe you have put some money in a fixed deposit, you are earning interest, or you could have bought some treasury bills or treasury bonds and you are earning interest as an income, whichever source of income. Whatever it is, you consider it that way as an income. Good. Once you do that, you get what we call profit before tax. Whatever it is, profit before tax. Then from there, you come and now less taxation. Now, listen. For taxation, I hope you still remember, there could be various types of taxes that should be charged in the income statement. One of them is what we call the current tax. Some books will call it corporation tax. That's what you used to call in accounting, either corporation tax or current tax, whatever it is. I am putting the amount on the inner column. Then you may have, in that question, you may have another form of tax, which we normally refer to as deferred tax. I know you know, because we are revising, when it comes to deferred tax, that charge for the year that you have calculated, that charge for the year, you either add it to the current tax or you may be required to subtract it from the current tax. I do hope you remember that. Of course, we shall do an example. So when we shall come to that example, we shall have to ask ourselves, shall we add or subtract? When do you add? When do you subtract? That we can discuss later as we are doing that question. But for now, just know that when it comes to computing the tax charge for the year, you take the corporation tax, or what we are calling the current tax. Then if the question has a deferred tax, whatever is the charge for the year for deferred tax, either you add or you will subtract. Either you add or you subtract. Whatever you get, That becomes the tax expense. Then you minus from the profit before tax, then you get what we call profit after tax. Okay, now listen carefully. Listen carefully. When it comes to income statement for publication purposes, we normally do not show the appropriation of these profits in the income statement. I hope you know that. In other words, I am saying, don't do like you used to do in financial accounting, where you used to now to come and say, after this you minus tax or you minus dividends, you say transfers to general reserves, maybe, get what you used to call retained profit for the year, then you add what you used to call retained profit brought down. That is okay for internal reporting. But for publication purposes, that's the point I'm saying, for publication purposes, we do not, get the point? We do not show the workings, or we don't show the appropriations of the profit on the face of the income statement. We don't show the appropriations of the profit on the face of the income statement. No. All appropriations are done elsewhere, and that is in the statement of changes in equity, as we shall see later. Okay, so just know that when it comes to income statement for publication purposes, or in other words, whenever you realize the question is the one for published accounts, once you get the profit after tax, you stop there. Then, listen, I also hope you remember, if the question tells you to prepare a statement, listen, prepare a statement of comprehensive income. Prepare a statement of comprehensive income, then you don't stop here. If the question says number A, income statement, then you stop after getting profit after tax. But if the question says number A, prepare a statement of comprehensive income, then from there, now you come and show what you used to call other comprehensive incomes. Other comprehensive incomes. Okay? Other comprehensive incomes. I do hope you remember what are some of the examples of other comprehensive incomes. One of the examples of other comprehensive incomes is what we were giving as a gain, as an example, gain on revaluation. Gain on revaluation of fixed assets. When you revalue some of your fixed assets, maybe machinery, motor vehicle, land building, that gain on revaluation should be considered as part of other comprehensive income. The other one we gave was what we were calling exchange difference. Exchange difference on what? On translation of translation of financial transactions from one currency to another. You all know, whenever you translate one currency from one currency to another currency, whenever you translate a transaction, put it that way, whenever you translate a foreign currency transaction from one currency to another currency, you as a company, you stand to gain or lose just because of the fluctuations in the exchange rate. Those changes, that gain or loss you are suffering or gaining just because of the fluctuations in the exchange rate, that difference is what we call the exchange difference. That's another example of what we can classify as part of other comprehensive income. Assuming those are the only ones, we normally get the totals, and then once you get the total, you now call this figure total comprehensive income. You call it total comprehensive income. Total comprehensive. This is total comprehensive income. Total comprehensive income. Good. So listen, I've reminded you a bit first on how to prepare an income statement for publication purposes. I've reminded you very fast how you had to prepare an income statement for publication purposes. One key point I've said, bring in the sales. That does not change. Most of the times you find maybe the sales calculations, the sales figure is not affected most of the times. But if it's affected by whatever adjustment the question is trying to give you, adjust and bring the right amount. Cost of sales is what I've told you. It is something you have to calculate somewhere. That is obvious. You will have to calculate it somewhere. You know how to get the cost of sales, but we are saying don't show the workings of the cost of sales on the face of the income statement. No. Work it out somewhere, bring it as a single amount. Get the GP, then I've said minus the expenses. I've told you those expenses should be classified according to their function, either as admin expenses or as a selling and distribution expenses. Again, those two figures, you will have to work them out somewhere, not on the face of the income statement. No, work them out somewhere, bring them as a single amount, either for admin or distribution. Get what we have called profit from operations. Okay, then I've told you charge the finance cost. That one we have dealt with a bit of time. In fact, we are not through yet. There are a lot of challenges, especially in that area of finance cost. But I've just highlighted a few of those challenges. I've only given one example of a finance cost in terms of interest, and the second one, which is preference dividend. I have emphasized and said it is only preference dividends on redeemable preference share. Why? Because they are loans. You are borrowing through issuing redeemable preference. So the cost of borrowing is a finance cost. That cost of borrowing is called preference dividend. Good. Then you come and add the investment income, whatever it is, get the profit before tax, then you minus the tax expense, whatever it is. I've told you for the tax expense, you take the corporation tax. If the question has deferred tax adjustment, do the calculation for the charge for deferred tax and then get the charge. Either you will add or subtract from the corporation tax. Whatever you get it as the charge for the year for taxation, or what you can call the tax expense. Then you get the profit after tax. Then I've told you, if the question says you prepare an income statement, you stop at that point. If the question tells you to prepare a statement of comprehensive income, then you now come and find out from the question, what are the other comprehensive incomes? I've given examples like gain or loss on revaluation of fixed asset, any exchange difference on translation of foreign currency transactions, any exchange difference on translation of foreign currency transactions. Good. So before we discuss the second component, which could be the balance sheet, let's use this knowledge now to apply to a question now. Let's use that knowledge to apply to a question now. So I want to project a question I forgot. I should have shared it in the group. We want to do a question that came in November 2020. We want to do a question that came in your past papers in November 2020. That's the question I want us to do. So let me project it so that we do it together now. That was question number 2. That came in November 2020. So let me read it. It was question number 2. It says, the following trial balance relates to Tam Limited as at 30th September 2019. You are given in the trial balance revenue, inventory, cost of sales, selling and distribution. You are given admin expenses. You are given interest on loan note. You are given investment income, bank interest, leasehold building at valuation on 1st of October 2018. If you look at the list up there, our current year is ending on 30th September 2019. So if I'm given the value of the building at a valuation on 1st October 2017, that's the value by the beginning of this year. Are you there? Good. Then you have the plant and equipment cost and column cost stroke depreciation. So you are given one figure for cost, another figure for depreciation, accumulated of course. Then you have computer equipments cost and depreciation, motor vehicle cost and depreciation. Then you have available for sale investment. Then you have trade receivables, you have bank balance, you have trade payables, you have deferred tax. Again, you can see deferred tax is on 1st October 2018. Then you have ordinary shares of shillings 29 each. Then you have 8% loan. Of course, it will mature in 2021. Then you have a 10%. Now look at that one. 10% preference shares. The examiner specifically says in bracket what? Redeemable. Are you getting there? Redeemable. So this one now it is specific. You now know it's not a component of equity. It's a liability. Are you there? Good. So it means the dividends for it, we shall consider it not as an appropriation, but as a finance cost. Let me roll the question. After that, the trial balance goes on, and it says revaluation reserve or revaluation surplus. You are given general reserve, and you are given retained earnings on 1st October 2018. That's again the beginning balance. Additional information. Number one, on 31st March 2019, that's the end of the year. Is it the end of the year? No. Somewhere in between the year, because our year is ending 30th September 2019. So somewhere on 31st March 2019, the company made a bonus issue from retained earnings of one new share for every 4 shares in issue at 10 shillings each. This transaction is yet to be recorded in the books. The company paid ordinary dividends of 2.2 per share on 31st of January 2019 and 2.6 per share on 30th June 2019. Dividend payments are included in the administrative expense in the trial balance. So, of course, listen, there they are testing you several issues. Let me take you through that. Note number one, the company issued some bonus shares on 31st March 2019. Then their company has a policy of paying dividends twice in a year. The first dividend, listen, the first dividend was paid on 31st January 2019. They paid at a rate of 2.2 per share. The second dividend was paid on 30th of June 2019. Listen. So when I will be computing the dividends for the year, it will be that you have to ask yourself, how many shares were there in the company before January 31st? Those which were there before January 31st, I pay them at the rate of 2.2 per share. I hope you are following. Then, because the company made a bonus issue on 31st March, 2 months later, after making a bonus, come June, they paid another dividend at 2.6. So it is obvious, after 31st of March 2019, the number of shares are no longer the same because they gave a bonus. So you will now be required again to know, after bonus, how many shares were there in the company. I hope you are following. So that whatever you get as the number of shares after the bonus, those ones now will be paid a dividend at the rate of 2.6. The other issue the examiner is testing you here is, they have told you, the last sentence in note 1, dividends payments are included as admin expenses. Was that a right treatment? It's obvious no. Dividend is not an expense. Dividend is an appropriation of profit. So that means again, once you compute the true dividend, because you have to calculate it, it will be required of you again to find out what was it done, what was done with that dividend. They took it as an admin. So you will remove it from admin expenses. I hope you are following. We shall remove it from admin expenses and take it as an appropriation of profit. But let's read the whole question first. Let's read the whole question. But I've introduced you, or I've told you, how that note number 1 was being tested to you. Number 2, interest on loan note. It could be interest on debenture, interest on loan, whatever. Interest on loan note and dividends on preference have not yet been accounted for. That one we shall account for it in the right way. Number 3, revenue includes shillings 8 million for credit sales. Revenue includes shillings 8 million for credit sales made on a sale or return basis. That's how the goods were sold, the 8 million. They were sold on a basis we normally call sale or return. Then the question goes on to say, as at 30th September 2019, customers who had not paid, they are our debtors, customers who had not paid for goods had the right to return 2.6 million of them. 2.6 million of them. Tamtam industry applied a markup of 30% on all sales. In the past, the company's customers have sometimes returned goods under this type of agreement. Okay, let me just explain to you. What they are saying is this, that you as a company, you have a policy of selling some goods, not all of your goods. Some of your goods, you normally sell them on what we call sale or return basis. Meaning, a customer has a right to return. And so the question is saying, listen carefully now, during the year, you sold goods worth 8 million on that basis. Come the end of the year, 2.6 million of them are still with the customers, are still with your customers that you sold to. And they have a right to either return the goods or keep the goods at the end of the year. Listen. So the tricky part of the question is not on the 8 million. No. The tricky part of the question is on this 2.6 million. Out of the total sales in the current year, you sold goods at 8 million. It seems some customers have already utilized the goods and consumed the goods. But by the end of the year, there are some remaining with the customers who have not paid. What, how much? 2.6 million. And they have a right to return or keep the goods. Now listen. If they have a right to return the goods, can you claim that you have sold the goods? if you have given your customer goods worth 2.6 million and you're telling them, you can return them anytime, I take them back. So when you sold, you remember you sold them on credit. So what did you do when you sold them? You must have debited data. You must have credited sales. That's obvious. You must have debited data initially by 8 million, but out of 8 million, only now 2.6 is remaining. So you must have debited data by 2.6. You must have credited what? Sales. Don't write. But then the question is this. Because the customers have a right to return them, can you claim, you as a company, that you can take this 2.6 million as a sale? The answer is no. Because they can return the goods anytime. So one thing the examiner was testing you here is, when goods are sold on sale or return basis, you don't have to consider a sale. That's one point. There are many points here. You don't have to consider a sale. No. But our company considered as a sale. In fact, we are told some customers have not paid. So what do? We shall have to reverse the entry. Not for 8 million, but for 2.6 million, we shall have to reverse that entry. How do you reverse the entry? By debiting sales and crediting debtors by 2.6 million. So what does it mean? It means the debtors figure I'm given in the trial balance, the debtors amount is wrong. It's overcasted by 2.6. When we sold the goods, we sold them like a normal sale. That's what you recorded as a company. But is it a normal sale? It's not a normal sale because it's one that can be returned anytime. So do you still consider them as a sale? No. You only consider that they are not in your store, but they are still yours. They can come back anytime. So they are still your goods. So what you shall do here, we shall have to reverse the entry that you made when you sold the goods. They are still yours. Now, it means again that the sales figure I'm given in the trial balance, that sales figure is wrong. Is it overcasted or undercasted? It is overcasted by how much? 2.6. 2.6. Good. So that's one part of the issue. Listen to the second one. That part was a bit tricky. Every time you sell goods to your customers, you normally sell them at a markup of 30%. At a markup of 30%. Remember, I've told you, you don't consider like you have sold the goods. They are still yours. They can come back to you anytime before the year ends. So if these goods come back to you, they will be part of your closing stock. They will be part of your closing stock. So what does it mean? It means that whatever closing stock figure we are given in the trial balance or in the additional information, wherever we are given, that closing stock amount is wrong. Why? Because these goods can be returned anytime. The customer has a right to return them. And if he returns them before the end of the year, I will put them in the store. And they should be part of my stock. So we are saying the figure of the closing stock I'm given is wrong. Wherever it is, whether it's in the trial balance or in the additional, whatever closing stock figure I'm given is wrong. Listen, is it undercasted or overcasted? It is undercasted because these goods could be brought back. So if they are brought back, I'll add them to whatever I have. 2. Because the closing stock was undercasted. Listen carefully. Because the closing stock was undercasted, it also means that whatever figure you as a company used as your cost of sales, that cost of sales is wrong. Why? Because the closing stock you used did not include these goods. Are you there? So you will have to ask yourself, when closing stock is undercasted, what effect did it have on the cost of sales? What effect did it have on the cost of sales? When closing stock is undercasted, is the cost of sales overcasted or is the cost of sales undercasted? That's the issue we want to find out. It is obvious. When closing stock is undercasted, cost of sales is overcasted. Listen, we normally take opening stock. Listen carefully. We normally take opening stock. We normally add purchases. We normally get the goods available for sale. Then from that goods available for sale, we normally deduct closing stock. So if we deducted something small, which we did, we deducted something small, then the cost of sales we got down there, that cost of sales is obviously more because we should have deducted a bigger amount. These goods that are with the customers are still ours. They can be brought back anytime. Okay? So because they can be brought back anytime, we should consider them as part of our stock by the end of the year. So the closing stock I am given somewhere in the question, that closing stock is undercasted. So when they were getting the cost of sales that they used, they took the opening stock, added purchases, they subtracted closing stock. But this closing stock they subtracted is wrong. It is less. So when they subtracted something less, they remained with a bigger cost of sales. But now they should have subtracted a bigger amount. So it means if they had subtracted a bigger amount, they should have remained with a smaller cost of sales. But now they remained with a bigger cost of sales. So in our question now, we are saying, even the cost of sales that the question has given you is wrong. That cost of sales is overcasted. So I've said, listen there, the closing stock is undercasted. They did not add that bunch of stock in their bunch when they were doing stock take. So the closing stock I'm given is wrong. So the stock you'll take to your balance sheet, you will add it to this other stock. Number two, that stock we used to compute the cost of sales, that stock was wrong. So the cost of sales figure we are given is wrong. Is it undercasted or overcasted? I've said they used a smaller closing stock. So from the goods available, they deducted a smaller amount. And therefore, they remained with a bigger cost of sales. So our cost of sales is overcasted. So we shall have to correct it. The third issue. There are three issues being tested in that note. Listen to the third issue. Now, shall I listen to whatever closing stock I'm given? Let us assume I'm given closing stock of 10 million. Will I add this 2.6 million? Because we are saying it's true. The closing stock I'm given is undercasted. Will I add the 2.6 million? The answer is no. The answer is what? It's no. Why? Because you all know the policy of valuing stocks. In any business, whether it's a sole trader, whether it's a partnership, whether it's a company, stocks are always valued at the lower of cost and net realizable value. In simple, stocks are valued at cost. At cost. This 2.6 million is the selling price of those goods. So when I was adjusting the sales and the datas here, when I was adjusting the sales and the datas there, I used 2.6 million. Are you there? I just had to reverse the entry. When the goods were sold, we must have debited datas, we must have credited sales with 2.6 million. But you did that as if they were a sale. I have told you, are they a sale? No. When goods are sold on sell or return basis, you don't consider a sale because they can be returned to you anytime. So what the examiner wanted you to do is to reverse the entry, which I've done. I've debited sales, credited debtors. Good. 2, I've told you the closing stock is undercosted and the cost of sales is overcosted. So to get the correct cost of closing stock, I've asked you, will I add the 2.6 million to whichever closing stock I'm given? The answer is no. Why? Because this 2.6 million is the selling price. This is the selling price of those goods. Yet, stocks should be valued at cost. So this 10 million, I have no problem. It's already at cost. But I cannot add 2.6 million. Listen, that's why the examiner went further and gave you what we are given as the markup. Some questions might give you the margin. This one gave you the markup. Why were you given the markup? Listen carefully so that you use it to ask yourself, how much out of this 2.6 million is the cost? If I'm able to get the cost, then it is that cost that I will add to the 10 million or to whichever closing stock that I'm given. Are you there? Now we are saying, listen, now we are saying, how do you get the cost? Can I get the closing to get the cost? Of course, you know selling price is equals to cost plus profit. You know that. To get the selling price of something, you normally take cost plus profit. Now I want to get the cost. So to get the cost, it is obvious I should take the selling price, I minus the profit in that selling price. Now my question is this, and I want you to answer me now. To get the profit out of this 2.6 million, can I just take 30% of it? Can I take 30% of it? It's either yes or no. Somebody's asking a question. What are the examples of admin expenses and what are the examples? Where? Who is this? Garang. What are examples of admin expenses? All expenses that are considered as of administration in nature, like office rent. We use office for administration. Office salary. Maybe you are having staff who are doing the office salary. They are normal administration work. Their salary is an administration. Electricity of the office is an administration expense. Insurance of the office is an administration expense. Depreciation of office machines, those are all administration because they are used for administration. You have also asked, what are examples of selling and distribution? Any expenses that are incurred in the process of selling and distribution, that is classified as a selling and distribution. For example, the salesmen are paid a salary. They are involved in selling and distribution. So the selling and distribution expense examples will include salesman's salary. Another one could be advertising. We normally incur advertising for the purpose of selling. Another one could be provision for bad debts. You know provision for bad debts come because of selling. When you sold goods and some debtors are likely not to pay you, you make a provision. So those are some of the examples of selling and distribution. Then there is Linda who is saying, giving me deferred tax. Maybe he was answering a question. Somebody is saying, again, Garang, what is the effect of overcast and undercast of closing stock? I think I've explained it. I think I've explained when closing stock is undercasted, like in our case, the closing stock was undercasted. When closing stock is undercasted, what effect did it have on the cost of sales? I've told you, you normally get cost of sales how? By taking opening stock, add purchases, you less closing stock. So if the closing stock is wrong, even the cost of sales will be wrong. So our closing stock is undercasted. This company could have used 10 million instead of a higher amount. So when they used a closing stock that was undercasted, cost of sales was overcasted. That's what I told you. Good. But the question is this now. This 2.6 million is the selling price. If I can know how much is the profit loading on that selling price, so that I remove the profit loading, then I'll be able to remain with the cost. But my question was, to determine the profit out of this 2.6 million, can I just take 30% of that 2.6? Can I take 30% of that 2.6? Tell me yes or no. I want to see. Can I take 30% of that 2.6? Can I take 30% of that 2.6? The answer is no. You cannot just take 30% of that 2.6. Why? Remember, we have done branch, and in branch accounts, there were those issues. Here you are given, this is markup. Here you are given selling price. You know, markup is GP. Listen, markup is GP divided by cost of sales. That's how we get markup. It is GP divided by cost of sales. So, if I use the markup, it means I don't know the GP and I don't know the cost of sales. So it's obvious I cannot use markup on the 2.6 because 2.6 is the selling price. And 30% is the markup. And markup goes with the cost of sales, not with the selling price. Listen. So for this question again, the other tricky was, the examiner wanted you to remember, because you are given markup and you are given selling price, you did not need the markup. You needed what we call margin. Because you know margin is GP divided by what? Sales. So if I can be able to get the margin and I know the selling price, then it means I'll only be left with one unknown. I'll be left with the figure called GP to be the unknown. You can solve that. As compared to when you use markup, you don't know the GP, you don't know the cost of sales. That will leave you with the two unknowns. But when you know the margin and you know the sales, then you can say the only unknown is the GP, which I can get. So the trick here was you had to remember. Listen, the trick here was that you had to remember how to convert your markup, which in our case is 30%. How do you convert it to margin? Just to remind you, when you're converting markup to margin, you normally take the numerator and let it remain the same way. Then you take that same numerator and add it to the denominator. So it will be 100 plus 30, which comes to 130. So our markup will be 30, the margin, will be 30 divided by 130. That's how we normally convert markup to margin. That you take the numerator, whichever the figure it is, take that numerator and add it to the denominator. That will give you the margin. Listen, there are other questions where you may come across that you need markup, but the examiner has not given you the markup, he has given you the margin. So if he gives you margin and you don't need it, you need markup, what do? You take the numerator and now you subtract it from the denominator. That will take you back to your markup. So if you're given the margin, like in this case, 30 divided by 130, and you don't need margin in that question, maybe you need the markup. When do you need markup? Maybe the question has given you cost. You are told the cost of the goods, blah, 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 was this. And you are given the margin of the goods was this. So again, you can't take margin on cost. The two don't go together. So if you know cost, you need markup. If you know selling price, you need margin. But If you are given margin and you need to convert it to markup, just take the numerator, subtract it from the denominator. If you are given markup and you don't need markup, you need margin, just take the numerator, add it to the denominator. Listen, so for this question, you needed the margin, which we have got as 30, divided by 130. Now you multiply that by 2.6 million. That will give you the profit loading in that, which is like how much? Just for the sake of it, which is like how much? For the sake of it, though we shall put down the workings. Don't write anything. We shall put down the workings slowly. So this comes to be 30 divided by 130. Multiply that by 2.6. That gives me a profit of 0.6 million. So it is automatic that the cost would be 2.6 minus 0.6. So that means the cost is 2 million. Now you know the cost. So whatever closing stock the examiner has given you, we shall find out. You will add the 2 million to the closing stock. Then, whatever cost of sales the examiner has given you, it is overcosted. You will deduct how much? 2 million. So you can see how that tricky note number 3 was. They wanted you to know how to deal with what we call goods that are sold on the sale or return basis. That you don't consider a sale. No, because the goods are still yours. They can be returned anytime. So if you had to consider them as a sale, reverse that entry. Because they were with somebody, you thought they are not yours, so they do not include in their closing stock. They are still yours. So bring them back to your stock. They are yours. Wherever they are still yours. So bring them back to the closing stock, but you bring them back how? At cost. Not at selling price, at cost. That's why we have to calculate the cost first. I think I'm through with that note number 3. Just to remind you. Let me read note number 4. Then maybe we can put down a few of those workings so that we continue together. Note 4 says what? Depreciation on property, plant, and equipment is to be provided on the following basis. Let me roll the question. We are reading number 4. Number 4 says, depreciation on property, plant, and equipment is to be provided on the following basis. Plant and equipment, you charge 10%, and listen, 10% on cost. And the policy of this company is to be charged where? To the cost of sales. Every time you depreciate a plant and equipment, this company says you charge it where? To cost of sales. Next one. You're also required to depreciate plant and equipment at what rate? At 25%. And the policy is to charge to where? To administrative expenses. That's where we shall charge. That's their policy. Motor vehicle, you are required to charge at 20% on reducing balance and charge to selling and distribution. That one is not a big deal. That one we have nothing to discuss. That one, as we are doing the computation of the admin, distribution, cost of sales, we shall be charging those items effectively. Number 5. Number 5 says, Tamtam Limited revalues its building at the end of each accounting period. Not at the beginning, but at the end of each accounting period. Then they are saying, on 30th September 2019, the relevant value to be incorporated in the financial statement was 14.1. For what? For the building. Then the note goes on to say, building remaining useful life as at the beginning of the year, current year, was 25 years. Tamtam Limited does not make an annual transfer from revaluation reserve to the retained earning in respect of realization of the revaluation surplus. That is not a big deal. Next, Depreciation on the building is an admin expense. Ignore deferred tax on revaluation. So let me explain the whole thing there. Let me explain that note number 5 so that you understand it. Here is the issue. Listen. This company revalued their building at the end of the year. To how much? To 14.1 million. So it is obvious by the end of the year, you will need to determine the gain or loss on revaluation. That's obvious. But when you look at the trial balance, we were not given the value at the end of the year. When you look at the trial balance, let me roll the question. This building, we were given the values by the beginning. If you look at the trial balance, you can even see there, somewhere in the middle, leasehold land, a leasehold building at valuation on 1st of October 2018. That is how much? 14 million. Our figures are in thousands. According to the trial balance, our one accumulated depreciation, the others have, but that one does not have. So that must be the value by the beginning here. Listen, 14,000. Listen carefully. So this question wanted you to confuse and say, oh, the building has a value of 14,000. By the end of the year, it was valued at 14,100. Therefore, it must have made a gain of 100. The answer is no. You cannot compare the value by the beginning and the value at the end. You have to compare the values at the same point. So, for this question, the examiner was asking you to first calculate what was the net book value of the building as at the date of revaluation. What was the book value? We are given the book value by the beginning, which is 14. But I don't want the value by the beginning. We are not revaluing the asset by the beginning. We are revaluing the asset by the end of the year. Listen carefully. Another question we did during the normal class, the company revalued their building, I don't know which was building or what, at the beginning. So for that question, we computed the gain or loss at the beginning of the year. They revalued it at the beginning. This one, they are revaluing it at the end of the year. It's important to understand the concept of revaluation. You must ask yourself, are they revaluing at the beginning or are they revaluing at the end? Listen, had they revalued at the beginning here at 14,100, then I could say simply the gain is 100. That's obvious. But they did not revalue at the beginning. They revalued at the end. So the trick was first get the book value. How do you get the book value? By taking the value by the beginning, this 14, then you depreciate it for this year. Depreciate that building for that current year. This 14 is by the beginning. The question has told you that the plant or the building, as a note somewhere we were told, the building, that was note number 5, the building, second paragraph under note 5, the building remaining useful life at the beginning of the year was 25 years. Good. So we are saying that's true. The value of 14 was the value by the beginning, but it had a remaining useful life here of how many years? 25 years. It had a remaining useful life of 25 years. So the examiner wanted you to know by how much has it lost value by during the current year. Let me divide that 14,000. I divide by 25 years. Every year, my building is losing 560. Because it's only 1 year, then I can get the book value. I take that 14,000 minus 560, which is the value, which is the depreciation charge for the year. I get how much? So this is 14. I'm getting a value of 13 or 40. Now I can say, listen carefully, now I can say The value of the building by the end of the year, the book value was 13,440, but it was revalued to 14,100. So it is obvious there was a gain on revaluation of how much? So I come and say, how much is the difference? That looks like 660. So that's how we shall treat that note. They are testing you. Listen, they are testing you on two things there. One, determination of the gain or loss on revaluation. Two, they are testing you on depreciation charge. In fact, they have told you, let's go back to that note 5. They have told you the building's remaining useful life is 25 years. The company or Tam Limited does not make an annual. No. Somewhere they told us something. Good. The next sentence. The last sentence in note 5. Depreciation on the building is an administrative expense. Good. So this 560, we shall consider it again as an admin expense. We shall consider it as an admin expense. Are you there now? Good. So there are two things they are testing. One is the determination of the depreciation charge for the year, that 560. Number two, they are testing you on the determination of the gain or loss on revaluation. Now, listen carefully. I've told you another question we did in the normal class. In that question, the company revalued their building at the beginning. Let's say 14,100. So if they revalued it at the beginning, listen, to calculate the depreciation charge for the year, now you will not use 14. You will say, okay, it was revalued at 14,100. Then what is the charge for the year? So you will take 14,100, divide that by the remaining useful life, which is 25 years. So how much you will charge as depreciation will depend on whether they revalued at the beginning or they revalued at the end. If the question is one where the asset was revalued by the beginning, listen, it means you start depreciating it on that value from now onwards. So for this question, when will they start charging on 14,100? It is obvious next year, not this year, because they revalued it at the end of the year. So it's next year that they will start depreciating it on 14,100. So next year, watachukua 14,100 divided by the useful life, whatever they would have estimated to be. Okay? But for this question, they are not revaluing at the beginning. If they had revalued at the beginning, then I've told you, you would compute the depreciation charge for the current year on the revalued amount. Good. That is it. So that's all for note number 5. That's all for note number 5. We shall put it down properly. But I just want you to get the key issues that the examiner is testing you on. Number 6. What's issue number 6? Number 6, they are saying available for sale investment was held as a 30th of September 2019 at a fair value of blah. That's a financial instrument. We shall discuss that when you revalue a financial instrument that is considered for available for sale. What do? Of course, listen, when you revalue a financial asset which is held for sale, the gain or loss on disposal or the gain or loss on revaluation, the question or the accounting standard just says, take it to the P&L account. We shall put down that information. Number 7 is a long explanation there, which I'll explain next time because I may not be able to finish it now. Remember, I have another class, so you will allow me to stop there. I'll discuss notes number 7 afresh. I have discussed the others. Note number 8 is not just information that the tax was this for the year and the deferred tax is this. So number 8 is not a big deal. Number 7, I will explain it in details next time. It will take me a bit of time to finish explaining, but maybe we can just read it. It says, in February 2019, Tam internal audit discovered a fraud committed by the company's credit manager, who did not return from a foreign trip, business trip. The outcome of the fraud is that shillings 500,000 of the company's trade receivables, shillings 500,000 of the trade receivables, those are debtors, was stolen and are not recoverable. Of this amount, 200,000 relates to the year ended 30th of September 2018, and the remainder to the current year. Let me just explain in a short while. Listen, your credit manager stole some money. How much? 500,000. That money was from a customer who had paid. That's what we are told. Read it again. Tam Limited or whatever discovered that this credit manager did not return. The outcome of the fraud revealed that 500,000 of the company's trade receivables was stolen. They stole the money that we received from a customer. That's the data. How much? 500,000. Listen, 300 out of this, I don't know whether it's for the current year or last year, let me see. Of this amount, 200 relates to last year, the remainder this year. So 300 is for the current year. 200 last year. What do? Listen. The customer had paid, but we had not recorded it. We took the money and it disappeared. That's what the manager did. But shall we follow the customer? No. We shall not follow the customer. The customer has already paid. It's only that because of our internal system, the money was stolen by the manager, who went to the foreign trip and he will never come back. Good. Now, first, we shall have to reduce the debtors. The customer has already paid. So we shall have to credit debtors by how much? By the same 500. There's part of the amount he had not paid last year. There's an amount he had not paid this year. But either way, in the debtors account, it doesn't matter. Debtors balance is always a current accumulative balance. So whatever he owes us up to now is accumulative balance. So we shall credit debtors by 500 because he has already paid. 300 out of that is for the current year. So that 300, we shall consider it as a loss for this year. It's a loss. The customer has paid, but we can't get back. So it's a loss. You charge it to the P&L account. That 300, we shall charge it in the P&L account as a loss for this current year. So among the expenses, there is that bad debt. Where shall we put it, of course? Among the selling and distribution. It's a bad debt. The 300. The last tier one, listen, does not affect the profit for this year. So it's true it's a loss, but it is not affecting the income statement that we are preparing for this year. It affects the profit for last year. You get the point there? So the profit for last year, which we brought down this year, that profit is wrong. That profit is overcasted. Because there's an expense they were supposed to charge last year of 200 as a bad debt of last year. They never did it. So that retained profit brought down this year is also wrong. It's not the profit for the current year that's wrong by 200. I've said the 200 for last year will affect the profit for last year. So we shall have to correct the retained profit brought down. Get the point there? So that's how we shall treat this loss. Yes, the customer has paid 300 for this year. We shall debit, listen, 300 for this year, we shall debit P&L account, which is bad debt, by 300, and we credit data by 300. So this year I'm debiting P&L account by 300 because the customer has already paid. So we cannot continue demanding from him. You go and reduce the data by 300. But at the same time, you recognize a loss this year. It's a bad debt. The other 200, I'm now saying, it's still a data I've paid. So you must credit data still by 200. But this time you debit, now not P&L account. Listen, you debit the retained profit account. You debit the retained profit. That's where we normally have a brought down. In other words, it's like you're debiting the appropriation account. Because after you have got the profit for the year, you normally say add retained profit brought down, get the retained profit carried down. All that is normally done in the appropriation account. So the profit for last year being part of the retained profit, it is that retained profit that we shall have to reduce by 200. There was a loss last year we never recognized. So this 200, we don't recognize it as a loss for the current year. We recognize it as a loss for last year, and the profit for last year, which was brought down this year, is wrong. Okay? Good. So I think I've even explained the concept behind that bad debt of 500. Either way, you must credit debtors. It's only that I'm splitting the 500, 300 for the current year, I still credit debtors. 200 for the last year, I still credit debtors. Because debtors account is a cumulative balance. It doesn't matter how many years you owe us. Debtors account will show how much you owe me by now, whether for 2 years backwards or 3 years backwards, you still owe me this. But profit, we normally determine the profit for each year. So this year's profit is wrong by 300. Last year's profit is wrong by 200. Good. So allow me to stop there. Next time, listen carefully now. Next time we put down the workings for all those workings. We put them down slowly. Then now we do the income statement. Because I have explained how to prepare income statement. I've now gone through this question and we have looked at how this additional information. Listen. So, when it comes to published accounts, listen carefully. You may know the format of the income statement. That's not a problem. The issues come on the additional information. But you may know the general format. Sales, cost of sales, admin, distribution, profit from operation, finance cost, investment income. Those ones you may know. But the issues normally come with on the additional information. Why? Because there are no standard items that may be tested in the additional information. They can test you on anything you did even in section 1 of financial accounting. That can be tested. Okay? So it's important to understand the additional information and how to deal with them. Otherwise, good night. Allow me to stop there for today. I pick it up from there next time. I'm also going to share the question in the group so that you can attempt it before next time. Otherwise, good night. Good night. Bye for now.